Hey there, everyone. Happy Thursday and welcome to Chart This with Dave Keller. It's Thursday, November 14th, and I'm your host, Dave Keller, Chief Market Strategist here at Sierra Alpha Research, coming to you from a beautifully rainy but very green Seattle, really Redmond, Washington. Thanks for joining me every weekday after the close as we try to make sense of these markets. I think over the last week, reconciling this big gap higher with, in a lot of ways, a lack of follow through. And I would say what I've learned through the course of this week is you had the initial, sort of upside reaction with so many things gapping higher, an incredible resurgence continuing this uptrend that we've been experiencing, essentially through the course of 2024, and comparing that to a bit of distribution that we're seeing this week, right? We're seeing on a day like today, 10 out of the 11 S&P sectors finishing lower. We're seeing the S&P and the Nasdaq trending steadily to the downside through the course of the day. We're seeing small caps continuing to lead the way lower. All of those are sort of signs of distribution after an extended run. And often, major market tops kind of start that way, right? As you still are okay, right? The long-term uptrend is still good, but you start to see signs of distribution. What differentiates a brief buyable pullback, giving you a higher low and the next run higher, versus a market topping pattern that begins a long period of distribution, in a lot of ways at the beginning looks actually very, very similar. The kicker is how you differentiate them by the price action coming afterwards, right? Do you see stocks continuing to push higher? Do you see stocks reigniting an uptrend and pushing above resistance? Do you see stocks pulling back and establishing a higher low and seeing new buyers coming in? Some of these questions probably won't be able to be answered today, but these are the questions I think we'll be struggling with or certainly addressing in the days and weeks to come. We're here to go along that ride with you and try to analyze the markets the best we can. And hopefully this show kind of helps you move along in your own journey of improving your market awareness. With that in mind, let's get to our market overview and see what this distribution day kind of looked like. The S&P 500 finishing about 0.6% lower to just below 5950. So that 6,000 level will have to wait. We did trade briefly above there on Wednesday's session, that is. Did not get the close above there yesterday, and today's continue to push off of that level. And that's not a huge surprise, to be honest with you. Big round numbers like 5K, like 6K. I remember vividly years ago having Craig Johnson of Piper Jaffray at the time telling us at Fidelity, we called it CJ2K, Craig Johnson claiming an S&P 2000 level, which seemed absolutely insanely ridiculous at the time. How overextended would that be if the S&P got all the way to 2000? But big round numbers tend to have meaning. I mean, fundamentally, no real reason why S&P 6000 should be any different than S&P 6100. That is a human psychological factor, but it tends to work, right? So paying attention to that, pretty important. So for now, coming off of that 6,000 level for the S&P. The Nasdaq Composite about the same, down about 2/3%. That is mid caps and small caps as well. The small cap S&P 600 index down 1.25%. So smalls continuing to underperform large stocks. And that, that's really been the story of much of 2024. Small caps have not been particularly strong on a relative basis. There have been sort of moments where it's felt like they might resurge, but the story of the markets in 2024 in a lot of ways have been the strength in the Magnificent Seven stocks as mega cap growth stocks, but certainly the underperformance of small caps. And for now, that theme continues. The VIX actually pushed slightly higher, but not by much, to be honest with you. We're still sort of in the mid-teens, just above 14. VIX below 20 for me is a low volatility environment. That means low uncertainty. And, essentially the market's saying low risk of a lot of choppiness. Sort of feels like the market is in a healthy uptrend phase. Looking at the yield curve, you can see for the most part, rates coming down today as bond prices rallied. The TLT, which is a long bond ETF that we track, was up 0.6%. The 10-year yield was down slightly. We'll call it 442 for the 10-year yield. The long bond yield around 458, and the 5-year point just below 4.3%. The dollar index continues to push to the upside as we see continued move in that direction. Now, Mark Newton, who's been on my podcast here recently, was just quoted on CNBC. I saw. I'm not that sure if he was on the air or if that was just a report that he'd sent around, but talking about the dollar essentially, nearing the end of that move. He cited an indicator called the DeMark indicator. It's called TD sequential, which is an exhaustion technique that I've spent a lot of time using, and it's true. The daily and weekly charts are all sort of aligning potentially next week as a big as a topping signal. That's more of a counter trend signal. So that's kind of signal that will fire after you've had a big run. It's not a lagging indicator, but more of a leading indicator, trying to anticipate the trend. So for now, the trend in the dollar remains quite positive. That has caused a number of ripple effects just in the last couple weeks. Most notably, gold prices getting absolutely dinged by all of that. And I actually wrote an article earlier today for CNBC Pro, if you follow my work there, on gold stocks, the GDX, and what that weakness in gold has done to gold miners. So check out that work there if you're on CNBC Pro. Gold, for the record, today the GLD was down about 0.25%. Silver price is actually up. So a lot of times gold and silver tend to kind of move together. Today, a little bit of a differentiation there. Silver price is up about 0.7%. See kind of a mixed results for the rest of the commodity space. Worth noting, energy ended up being the only one of the 11 S&P sectors that actually finished in the green. Speaking of big round numbers and the challenges of getting above there and staying above there, we have Bitcoin that is pulling back from 90,000 just in the last 24 hours. It's gotten all the way up to 93,000 plus. Talk about an incredible upside follow through after being in a basing pattern for much of 2024, struggling to get above that 72,000 range. Finally, in the last week, has accelerated the climb to the upside, pulling back off of those all-time highs around 93,000, currently approaching the 87,000 level from above. So currently down around 3.5% from yesterday's close. And we say yesterday's close loosely. Bitcoin, Ethereum, and other cryptos trade 24 hours. So you take one spot in the 24-hour period and you call that the close. And that's a convention that comes from the currency markets that have traded for 24 hours for many, many years. It's kind of the convention that you use. So for now, Bitcoin down, Ethereum down. I do own both of those in my own accounts in the interest of full disclosure. All right. Looking at the 11 S&P sectors, we can see, as I mentioned, energy, the only one in the green, up about 0.4%. You can see the rest of the 11 S&P sectors all in the red. Communication services and consumer staples were number 2 and 3, again, slightly lower. On the downside, you have industrials down 1.7%. Healthcare, talk about a sector that's been on the struggle bus big time here recently. A lot of distribution signs in the healthcare sector, and the XLV was down 1.5%. Consumer discretionary down 1.4%. Tesla, which had a huge gap higher post elections, now getting some excessive selling on the way right back down. And again, the chart of Tesla, which I think I grabbed to address later because we did have some questions on that during the broadcast yesterday. I didn't have a chance to answer them, so I thought I'd include it as an example here today. Tesla, I think the chart of Tesla is an example of the danger of this particular market, right? And, it kind of goes without saying, but after you've had the upside reaction that you did post-election, kind of one of two general scenarios is going to play out. Either this is the beginning of a huge run into the beginning of next year where all the Trump-related kind of themes just accelerate to the upside. There's huge optimism. All the changes that he talked about making end up being, generally speaking, pretty good for risk assets. And so the equity markets continue to accelerate their gains. Or investors kind of realize how much of that optimism had already been priced into a market that's already up significantly in 2024. And this gap higher creates what are called exhaustion gaps, which are those gaps at the end of a big move, which usually are sort of that last frothy, one last push higher, last call before the lights come on. And all of a sudden we start to rotate lower. And the chart of Tesla, I think, gives an example of the danger of this sort of market, right? What if that was the move? What if that was the exhaustion gap that we saw last week? And again, as I mentioned in the introduction, I think the way you differentiate those is by using good money management principles, using technical analysis. Focus on levels, what I call lines in the sand, right? A level, as long as you hold that, this new trend is still fine. And if we start to break those levels, then we have to be concerned. We'll look at some of the charts here today, and I'll update on some of the levels that I think stand out for me. Kind of mixed results here for the Magnificent Seven and friends, these mega cap growth names. We can see that Apple actually having a decent update, up about 1.4%. Apple is noteworthy among this basket of stocks because it really has failed to follow through to the upside, right? A handful of these Magnificent Seven names I would cite Meta as another example of that, really have not broken out, right? They kind of stalled out. And for a while now, really didn't get much of a Trump bump and really have not accelerated beyond the previous resistance. But for what it's worth today, Apple up 1.4%. Netflix moving higher by about 0.8%. On the downside, as I mentioned, Tesla, the big loser of this group of stocks, down almost 6% today. It was down a little more earlier in the day. Alphabet actually down almost 2% today. And that's another one to watch. Alphabet arguably putting in a big time lower high, which Charles Dow would tell you if he were alive today, he'd probably look at the chart of Alphabet and say, boy, it looks like a new downtrend by the fact that lower highs and lower lows are what a downtrend is made of. Amazon down over 1% as well. Let's get to the market carpet. And before we do so, I do want to let you know I have a webcast coming up next week, and I would love for you to join me. It is a free webcast. Love to do webcasts about once a month, time permitting and calendar permitting. I'm actually going to be in New York doing some events for the CMT Association. We'll be doing it from the hotel in New York, so fingers crossed all the tech works. But I'm pretty confident we're going to have a good discussion together. It's called From Patterns to Profits, the 3-step approach to technical analysis. If you like some of the charts that we talk about, how I talk about different ways of actually using patterns like cup and handle patterns, head and shoulders, tops and bottoms, just the general signals that we talk about. I often talk about follow through and the trigger and words like that. Here, I'll actually lay out sort of a mini masterclass on the 3 steps to every signal. I find a lot of times with technical analysis, if you're just getting started, you kind of simplify and you just think of a signal as a particular moment in time. The signal fired, okay, great, I make a trade. And what I've learned is there's actually 3 steps, and I'll outline the 3 steps. We'll go through some examples and show how waiting for those 3 steps to all be confirmed really helps improve your hit rate, improve your percentage of success using technical indicators. You can sign up for that event using the QR code that you see on your screen. Just scan that on your phone. You'll be taken to a sign-up page, or you can go to marketmisbehavior.com/3 steps. That's a free event coming up next Tuesday, the 19th, 1 p.m. Eastern, 10 a.m. Pacific. Hope to see you there. They're usually a lot of fun. All right, let's go to the market carpet here. And again, 3 ways that I like to use a heat map style visualization like this. Number 1, the big picture. What are my overall impressions? Number 2, the big dogs, the biggest names that have the biggest weights in our benchmarks. It's so important to monitor those here in 2024, given their outsized influence on our benchmarks. Step 3, look for some smaller, themes, right? Names and sectors doing things kind of unusual, the outliers, as it were. So step 1, general impressions. I mean, obviously sort of a mixed day here. I'm seeing, a lot of the color red, to be honest with you. One of the features I just noticed, they have this little kind of goofy button. I was thinking, why would I not want to see the symbols? But if you're just trying to get a sense of the landscape, it's actually a nice way to just sort of look. Are you seeing more green? Are you seeing more red? Is it localized in certain areas? And just forget, sort of take the bias away of knowing what the symbols are and immediately starting to think about what that might mean. Here, we're just looking at colors and the distribution of those colors. And, again, you're seeing some areas of the market that are more red than not. This is the healthcare sectors, things like Eli Lilly, Charles River, which we highlighted on yesterday's show. Some of the different names really across healthcare groups. There's some pharma represented here, some medical technology, services are all kind of commingled here together. I could put the symbols back on. But I'm noticing healthcare in particular certainly seem to have a weaker day. Industrials too, right? And industrials, a lot of these have had incredibly strong runs in 2024. Some of the names down the most today are things like Lockheed Martin, Raytheon. These are defense names, aerospace names that had incredibly strong performance really going into the election season. But then from mid-October to where we're at now, the Trump bump, as it were, last week, kind of creating a bit of a bounce. But overall, these are now more, showing signs of rotation, not really breaking down significantly yet, but not in a position of strength. Northrop Grumman, NOC, comes to mind as one that arguably has now made a lower high and a lower low. So watch for that sort of rotation, which a lot of times would tell you potentially further downside to come. Question 2, the big dogs, right? The big names. Alphabet stands out to me. Obviously, Tesla at the bottom, in the middle, down quite a bit today. We'll look at that chart here. Obviously, that was a stock that was bid up aggressively with sort of the emerging story that Elon Musk would have an active role in the administration. starting next year. Started to get a little more detail about what that might represent, although I still think it seems to be very much an open question. But Tesla obviously rallying very, very aggressively after that, those sort of announcements, now coming back to earth a little bit. But Alphabet and Amazon, obviously some of the bigger names, not really moving higher is a concern. Finally, looking at some individual kind of outliers, I'm noting in the discretionary sector Wynn, which is Wynn Resorts. It's up almost 9% today. And again, I would say that arguably that chart still has a lot to prove, because we're rallying off of a quick sell-off from 105, which is a clear resistance level, down to 85, and then kind of popping back up a little bit. So coming off of a fairly weak point. But the gambling stocks had struggled there in the month of October. Is this the beginning of a bit of a recovery? That's something I might want to look at there. In the financial sector, stocks like Charles Schwab making new 52-week highs today. So, areas of the market, even though the S&P and the Nasdaq have kind of stalled out a little bit, most of the Magnificent Seven stocks are not making new highs. Look for those names that are, and those are the stocks that would be on the 52-week high list. Those are the ones that you need, in this sort of environment to create sustained gains, right? If the market is going to push above S&P 6,000, you need the Schwabs of the world and a lot of other ones kind of breaking out to new 52-week highs. That's why one of the breadth indicators we track is stocks making new 52-week highs for that region. Finally, I would just highlight some of the counter trend rallies you're seeing in renewable energy. Again, I would say from a technical perspective, these charts are pretty ugly. That's a technical term, not particularly bullish in their construction, I guess would be the way I would diplomatically say that. But Solar Edge, First Solar, Enphase, all up about 5 to 7% today. And again, these are stocks that have been beaten down post-election, getting a bit of a counter trend run. So today, very much, when you look at underneath the hood and sort of look at the heat map, you can see a lot of these are sort of some of the weaker names starting to have counter trend rallies, like renewable energy, like gambling. Some of the leading names like aerospace coming back a little bit, sort of digesting some of those recent gains. Tesla as well. Let's get to some of the individual charts. As a reminder, I can see the questions you're putting in on whatever platform you're on. We're live streaming on X, on YouTube, on LinkedIn, on Facebook. I appreciate so much wherever you're tuning in from. I can see whatever comments you put on any of those platforms right here from the streaming page. So put your questions in now. I'll try to take one or two before we wrap the live stream. Anything we don't get to, we'll try to put it into our all mailbag edition, which will be tomorrow. All right. The S&P 500, again, still back above this trend line. This trend line is less and less of the perfect way to illustrate this current trend. But I can't help but notice that island reversal that we saw kind of going into elections and coming out of elections, it created that bullish island reversal that we highlighted, kind of a bullish development on the chart. It's funny that we actually gapped below that trend line, and actually after the island, we gapped right above the trend line. So, continuing that trend overall. I think once the trend line's been broken, I think it's less of a great representation of the pace of the trend. So I'd probably use that a little bit less. I would say when you think about some sort of drawdown and what it could look like if this is the beginning of something further, a couple things come to mind, like the ways you could do this. And I might draw a couple lines on here really quick, just so you get an idea. And I'll spend a little more time thinking about this. This is just sort of an initial assessment looking at the charts, right? So first off, let's make this a different color. First off, anytime you have a big breakout, I think you use the breakout level as an initial assessment of risk, right? So 58.75, which was really the peak from October, and that's what we gapped above. Note how the gap sort of ended. That's sort of the upper end of this price gap. That might be an initial line in the sand for me, right? And as long as we hold that, there's no way things are bad because we're sort of holding that level. Given what's happened recently, I'd probably put an updated level right around here, right? And that would be, it's kind of the level that we talked about before. It's that 5650 to 5700 level. What's interesting is we gapped right down to that level when we tested the 50-day moving average, and then we bounced higher. So that's still the most recent swing low. So again, that for me is still that line in the sand for this market. The 50-day moving average now quite a bit away from there. It'll probably end up being around 5,800, depending on how quickly we would sell off. But those are some of the initial assessments of risk that I would attribute to the downside. So, taking a step back from your monitor, the way that you make sense of noise in a week like this week is to say, all right, what level would we break that you would then say, if you hold a bunch of equities, if you're like all in long, what level would we break where you would start to go, okay, maybe I don't want to be super long at the moment, or maybe I want to take some of those bets off the table. What's interesting is, based on that assessment we just made, that level's around what, 4 to 5% below current levels, right? So if I take this today's close and I go down another 4 to 5%, that takes us to 5,700, and that would be around 5 to 6% off of the previous swing high. I think that's a reasonable expectation of as long as we hold a 5 to 6% pullback, that's pretty reasonable in a bull market phase. We start breaking below there, then there's an elevated risk that becomes a much more significant drawdown. So I would keep the line in the sand right about at those same levels. I think similar level to what we've talked about previously. All right, there's the chart of the S&P 500. Breadth indicators in some ways have gotten, improved a little bit, but not by much, to be honest with you. What you'll find if you look at the series of breadth indicators, at least the ones that I review, things like the bullish percent index registered a sell signal in late October. Here's the bump that happened sort of right around elections. We didn't get back to that sort of bullish sign of over 70%. We're sort of remaining in a, general kind of bullish range, but we didn't reinitiate any sell signal. So for me, that means the sell signal from late October is actually still in play. So, the breadth really hasn't improved dramatically. It's not like everything sort of broke out using the point and figure methodology that is the source of the bullish percent index. And that's why I would say after this gap higher, why I would say at this point, I'm skeptical of just a continued uptrend without some sort of pullback here. It certainly felt like that was a huge gap higher. But now the breadth conditions aren't telling me that kind of everything's emerging out of these, gaps higher and continuing to the upside. That's happening on a limited basis. But I think a lot of stocks, instead of gapping and running, are doing the old gap and drop, right? They're gapping higher, but you're seeing sellers come in and thrilled to take profits now that the price is up a little bit. In other news, sort of on the macro side, from a technical perspective, the 3-month to 10-year point, which is one of the ways to measure the shape of the yield curve, is very close to going back to a normal shape, and actually has been below for around 2 years now, is when the 10-year point broke below the 3-month point. And that means the yield curve is inverted. A normal shaped yield curve, short end is much lower than the longer end. The Federal Reserve is doing their best to kind of bring down the shorter end, which is very short-term durations. The 3-month point versus the 10-year point actually close to getting back to normal. What's interesting, and I was looking at work Katie Stockton had shared recently about the normalization of the yield curve. That usually doesn't mean great things for stocks for the next 6 months, right? Once the yield curve becomes more normal, it often is a choppy period for stocks and net negative before they eventually improve. And that has to do with the chances of a recession, what an inverted yield curve really means in terms of pessimism about future economic growth. Eventually, things start to improve. And this is the yield curve improving, normalizing is sort of optimism for, eventual economic growth. But usually stocks find a period of instability once that yield curve is more normalized. So something to look for here as we get toward year end and we have a yield curve that has been inverted for quite some time, is starting to be uninverted. In terms of earnings, right, the big news this week, you had inflation data, and honestly, no real significant surprises, although after the CPI and PPI numbers, you are seeing the markets obviously sell off through the course of the day, through the course of the week here. Disney is one of the names reporting earnings, kind of wrapping up Q3 earnings this week. Some sort of stragglers like Applied Materials, like Disney, which reported today before the open. Disney flashing a gap higher with positive earnings result. I didn't have a chance to review the specifics behind their earnings announcements. Can't really speak to the fundamental side of their earnings release, but I would say from a technical side, a couple observations. Number one, we have gapped higher, so obviously a positive reaction. This candle pattern, by the way, is the old shooting star candle, which doesn't tend to be a good sign. A shooting star candle is what happens in an uptrend. When you open, we trade much higher, but we close back at the low. So think of what happened, right? They reported earnings this morning. The market opens much higher, revalued to the upside around $109 a share. That's not true. Just above $110 a share at the open. We traded all the way up to almost $115, but by the close, investors were selling off, or traders were selling off on that strength. And by the close, we're back down to $109. And that happens pretty often when a company beats earnings, but the general market trend is more negative, right? Because investors generally are kind of taking risk off. They're not adding risk today. So finding great things like this where you can cash out after a big gap higher just tends to make your returns a little better. The last thing I would note is the RSI is above 80, which is called an extreme overbought condition. I don't have time to go through that in too much detail, but I did do a video earlier this week on the Stock Charts TV YouTube channel specifically about that extreme overbought condition, looking at examples like HubSpot and NVIDIA. We did not talk about Disney, but think about what we talked about in that video relative to that gap higher might help you think about what that might mean for the long-term story for Disney. Applied Materials reporting earnings today as well. I think they're after market. I didn't really look too closely at what was happening in the after-hour session, but I think semiconductors obviously have been struggling quite a bit. The SMH is not in a particularly good technical position, especially compared to others like software and other ETFs. If you look at Applied Materials support currently in sort of that 175 to 180 range, that has served as support a number of times over the last 3 to 4 months. I would look to see if that could be able to hold that 175 level. And by the way, I did talk to my guest, John Kosar, on the Market Misbehavior podcast. Just posted that episode yesterday. I think that's episode 11 of the new podcast. Having a lot of fun talking with smart people like John. So make sure you catch that on my YouTube channel. But we talked specifically about software versus semiconductors. And he was talking about the IGV, which is a software ETF. I think that's the right ticker. Yeah. All right. Tesla. We actually had some questions on Tesla in the chat yesterday. I didn't get to, but I do want to point out that I think the chart of Tesla is sort of the danger of this market, right? You've had a stock like Tesla, which was revalued aggressively to the upside, taking us above resistance around 270. On the surface, I would say that is certainly a bullish development, right? Breakouts are bullish, new highs are bullish. All of that is true. But then you have sort of that initial reaction. And I would say over the, sort of the 3 or 4 sessions after going into Monday's session, a lot of optimism for Tesla for a number of reasons. What's happened since then is you've seen actually Tesla come down quite a bit. Now, from a technical perspective, is this still an uptrend? I would say 100% yes, because we're making higher highs and higher lows. Does it concern me that after these gaps higher, we're now starting to see quite a bit of selling over the last couple of days? Certainly doesn't excite me. And I think, again, what you have to remember is after you've had a big run, it is totally normal to have a pullback. What you want to start doing is sort of defining those lines in the sand, right? That level that as long as we hold that level, conditions are probably fine. We start to break that level, you want to be concerned a little bit. I'm really looking at this sort of range, kind of call it this range, right? So you kind of take the resistance level, kind of take this gap and sort of mix it all together. Sort of that 265 to 275 range. That's the upper end of that gap. That's the breakout level that we saw from September and October. So there's that much room that Tesla can pull back and still arguably be within a primary uptrend. As an investor, I'm looking at that to see if those levels hold. And Tesla is not the only one with that particular type of pattern. I think these types of stocks that have broken out, holding those sorts of levels on a pullback are important. They start to fail holding those levels, then we have to be concerned about sustainability of this uptrend. All right, 1 or 2 others, and then I have a lot of charts on here. How do I have this many charts? All right, let's go quickly. GM, great chart. I wanted to highlight the fact that this is breaking out. And again, even with all the craziness around the elections, it's refreshing to me that they're just the classic breakout stories are working. And it's not lost on me that Tesla sort of gapping, trading lower this week, GM kind of pushing to the upside. So sort of old auto over new auto, I guess would be the general pairs trade that we're seeing here. Again, the break above $50 a share, I think, is pretty meaningful. I like the pullback and the higher low above that breakout level. I think that's a nice primary uptrend, really starting to reemerge in a position of strength. HCA is one of those healthcare stocks that have been struggling. We gapped lower in October when they reported earnings, and from there we've continued to drift lower. Now we're testing support at the 200-day moving average. Again, I think the trend here is negative. The bearish divergence that we saw in September, October sort of has followed through with the gap to the downside. But now the question is, do we hold support at the 200-day, which also lines up to the breakout level that we had in June of this year? So kind of an actionable point. I wouldn't mind taking a speculative sort of trade to see if we can bounce off of support. But I think on the longer term, still more to prove for that to be more in a constructive position. Lowe's is another one of those. They actually report earnings next week. This is one of those coming up. A lot of consumer names kind of report randomly throughout the quarter. But I would say the chart of Lowe's still okay in that we held an ascending 50-day moving average in the last couple of weeks. A bit concerning that this week may be setting up with a lower high, right? A lower peak around 275, undercutting the October low. The RSI stalling out around 60. And that's what a bearish trend looks like more often, right? Is on rallies you fail to get above 60. So the concern with this market, looking at individual stocks, are sort of the Lowe's effect. The Alphabet chart, which is stocks making lower highs in the month of November, undercutting, unable to get above their October high, and it's also the Tesla story, right? Stocks that accelerated with a gap higher last week after elections, and now what's the reason why those stocks are going to have consistent gains beyond the gains that they've already experienced in a very bullish 2024 in a lot of cases? Is there sustainability to those uptrends? Keeping an eye on support levels, I think, so incredibly important. All right, let's take some of the questions here. Someone asking about NBA, the NBA. I'm not going to acknowledge you by putting your question on there. I will tell you, I visited Climate Pledge Arena, which is where the Seattle Kraken plays, and I will tell you, when we did a tour of the arena, they do have the locker rooms all designed, and it just says NBA locker room. They got the room for the NBA refs, so they have all the facilities ready, waiting for the Seattle Supersonics to come back. So I do loosely follow the Cleveland Cavaliers, which, for the record, are having an absolutely incredible undefeated start to 2024. But after LeBron left, I kind of lost interest a little bit in the Cavs, I'll be honest with you. So I'll cheer for the Sonics when they come back, not if they come back, Seattle friends. All right, let's see what else. All right, on YouTube, Titus Ryder, thanks for asking, if the market is shifting into distribution mode, does it even make sense to try and buy anything for fear of getting sucked into the downdraft? I mean, honestly, this is one of those eternal questions, right? When you have an environment like this. And the reality is, regardless of the larger trend, we always have upswings and downswings, right? And so I would say, number one, remember your time frame, right? So if you're a swing trader, would I be buying today? I probably would not. Would I recognize that we've had a huge run aggressively off of the elections with a gap higher and then a couple days higher going into this week? Yes. And now am I seeing signs of rotation? I'd probably, as a short-term sort of swing trader, I'd probably be playing the downside and betting that there's more deterioration to be had because of the lack of follow-through, as we've cited through the course of just today's episode alone. On a longer-term time frame, though, what it tells me is maybe today's not the day to be adding, big new long positions, because if I'm seeing that continued weakness, most likely I'm able to get into good charts at a lower level. I'd much rather, if I think Tesla or Lowe's or any of these stocks are great long-term plays, I probably don't want to be buying them at a time when the tactical time frame is showing me more weakness than strength, right? I probably want to wait for that to play out. So looking for a pullback to give us an opportunity to get a better entry point, I think is kind of key. And I would say with a lot of charts, that's kind of the setup that I'm seeing there. I'm not seeing screaming buy signals on a day like today after we've had the pullbacks that we've had so far this week. I see a market in a short-term distribution phase. I think, still to be determined in terms of when that bottom may come in. But looking at some of these stock charts to see if they're able to hold support levels, if they're able to uphold those line in the sands, that's where you reinitiate a long position. At least that's how I would approach it, generally speaking. Thanks for asking about that. So short-term answer, I would say is yes. Remember, if you're looking at the market with a particular lens, you might have very different answers to that question. Think of a swing trading time frame as one thing. Think of a medium term or a longer term time frame differently, and that might mean you pull different levers at different times in the cycle. All right, Akira asking on YouTube, David, Powell said Fed doesn't need to be in a hurry to reduce interest rates. Does it signal or expect a pause in enthusiasm in the market? What do you think? I think, boy, this is going to be a fascinating, regardless of who you voted for, it's going to be fascinating to see how this resolves in terms of Fed Chair Powell, incoming President Trump. Obviously, some bad. There's some bad juju between the two gentlemen. And there's been speculation that Trump's talked about, the Fed, being less independent. I would strongly disagree with that as being a very good idea. I think one of the, as imperfect as the Fed is, and as absolutely impossible of a role that I think they are asked to play in the modern economy, I think being independent and focusing on economic evidence and not making political statements makes a ton of sense to this commentator. So I would say that that's number one. So I think having an independent Fed is incredibly important. Having said that, what do they do? I mean, I think, given the fact that we're in a rate cut cycle, given the fact that the Fed has talked about, their plans to continue to, cut rates data dependently, I guess, I think is the general trend. Now, all of a sudden, it's sort of the nuance, right? It's sort of thinking about what the pace of those moves could be. I'll show you actually very quickly here the Fed Watch tool, and then I'll have to wrap the live stream. This is the Fed Watch tool. If you go to just Google, Fed Watch tool, you will get to this free page from the CME. And again, back in the day, in my Bloomberg days, when I was learning about the Fed and interest rates and Fed funds futures, we actually would calculate this every day in an Excel spreadsheet and pass it around the floor. And we'd use that to talk to clients about what the futures market was pricing in, about expectations for the Fed. And now the Fed has picked up on that general thing that we weren't the only ones doing that. I'm quite certain. So they've provided this free resource to be able to do that calculation. If you're not familiar with it, too much detail to go into right now. But I would say what this is basically showing you is the current rate is 4.5 to 4.75% for the Fed target rate. These are the probabilities for the next meeting, which is about a month out, about 4 weeks out from this week. And it's basically saying a 59% chance of another 25 basis point cut, about a 41% chance of them leaving rates the same. But you can actually go out to the January meeting where you can see it's about a 50% probability of being a 25 basis point lower. We can see the probabilities further. And what happens is as you go further out, what you'll notice is that there's a lot of uncertainty, right? As you go further and further out, the markets are pricing in, a big question mark because there's a lot less clarity. When you get closer and closer to the next meeting, the market sort of coalesces around a general consensus. But even for the next meeting, it's not very confident actually. And that's after the comments today, right? If you look yesterday, you can see it was an 83% probability of a 25 basis point cut. As of today, that was chopped down pretty big because of the comments that you cited in your question. So I would say that was a long-winded way of saying a lot of people will be hanging on any sort of color from any Fed governor that might sort of give some clarity. What I would argue is barring some huge change in the evidence, barring some huge spike in some inflation data or jobs number or something like that in the next month, most likely we continue to see this slow pace of rate cuts. I think a 25 basis point cut at this point probably is the likely scenario, but that's why we have to pay attention to the data and pay attention to what some of those Fed governors would be saying, because any change in that trajectory could mean, obviously a change in that relationship of the yield curve, short-term to long-term rates, and sort of the ripple effects that those can create for investors. Folks, I want to thank you guys so much for joining me here on the live stream. I appreciate all the kind words and the feedback that I've received. I hope you were enjoying this show. It's been really fun to sort of redesign and reimagine and refresh this daily market recap that I've been doing in some ways for many years, but this is a new approach with new technology and new things that I'm showing, and I appreciate very much all the thoughtful comments and questions that you're providing for me. Plan on an all mailbag episode for Friday's show. I do a weekly market recap. A number of you have asked about that. That is reserved for my Market Misbehavior Premium members. If you want to learn more about that, go to marketmisbehavior.com/premium. And if you are piqued, if your interest is piqued by looking at all the features and the great benefits to my premium members, make sure you use the code DK2024, DK2024, and I'll knock 30% off your first 12 months on any plan. So I hope to see some of you there, but otherwise look forward to lots of great insights and market updates here on Chart This with Dave Keller. Have a fantastic rest of your day. And remember, it's always a good time to own good charts. Take care, folks.